We're here in our bunker for the 2026 Fallout Shelter. I've got with me 5 of my esteemed colleagues from Mission Capital Advisors and MMCC, Marcus and Millichap Capital Corp. We've been sitting in the same office for many years now, and up until recently, we've been working in our own respective silos until necessary. But given where events are unfolding and how the environment is shaping up here in New York over the past couple of years, we've found ourselves talking to each other more, collaborating more, and really advising clients in a group together, the 3 of us, all under one roof, at the same company, in the same office. So it's been nice over the past few years, not only to get to know you guys a little bit better, but start to collaborate and work more together. And that was really the main impetus to put this thing on here for the marketplace, borrowers, buyers, and certainly lenders together. I'll give everyone a little background. The origin of how we started really working together started a few years ago when Shaun and I were trying to sell these rent stabilized buildings, and the rates were rising, values were falling, and all the sellers would say, well, I can't sell at that price because you need to get my lender to take a discounted payoff. And the lenders were trying to sell the notes, but they didn't want to sell the notes at the valuations they were getting. So to maximize proceeds, we all had to come together and create this collaborative environment in order to maximize the proceeds. And that's what we've been doing. And that's what we've been encouraging the market to do, to create a transparent process. And now that all of us are at the same company, in the same office, next to each other, it's really starting to work out well. So before we get into it, I'll give the audience a little background and some agendas on what we're going to talk about. We're fresh off of the rent freeze announcement last week, so we're going to talk about the impact of the rent freeze, specifically a 2-year rent freeze, how note sales are underwritten, how lenders are underwriting New York City properties for refinances as well as acquisitions, and then how the 3 of us, or 6 of us, 3 groups, 6 of us, work together to create a collaborative, transparent environment to ensure a successful outcome. So I want to introduce everyone. I'm Seth Glasser, Shaun Riney, my partner at the New York Multifamily Group. We handle apartment building sales and valuations. To my left, Max Herzog and Jake Kahn from MMCC. These guys are placing debt all over the city. And to my right here, Spencer Kirsch and David Tobin of Mission Capital Advisors. These guys are selling notes on behalf of lenders all across the country. So that's the team here for the next 45 minutes or so. So Shaun, I want to kick it to you. Let's start off. What's been the initial reaction and impact from the rent freeze?
Well, I think it's important just to, again, set the table stakes. Last week, rent freeze for the first time in history, not only a rent freeze on 1-year lease, but on a 2-year lease, which was a drastic statement in the marketplace and pretty jarring. We weren't necessarily expecting a rent freeze on a 2-year lease, so we're working through the ramifications of this. But I think it's important to understand that most of the buyers, and I think most people want to understand, who is buying rent-regulated properties. The buyers of rent-regulated properties do their math on a napkin at this point. It's back to the very old school, salt of the earth. I'm not going to buy 15 of these, but I do want to buy at the bottom, or I hope close to the bottom, and maybe I cherry pick one building a year that really feels good. So as a broker, it's hard to find enough of those types of buyers, but that's generally the buyer pool today. It's not private equity, it's not institutions, it's not anybody that has to justify how to add value in the next 3 years, because there isn't any. So to that point, how are buyers underwriting rent-regulated buildings? If I don't have any expenses on a building, and it's call it typical 60 to 100 unit B plus, B minus, C plus outer borough rent-regulated workforce housing building, it's Shaun, what's the gross income? Okay. $7,000 to $7,500 per unit for operating expenses plus the real estate taxes. So from there, that's the baseline NOI. And I would say the baseline cap rate expectation last week, maybe 7% on a really quality building. Today, it could be around 8%, could be higher depending on how problematic the building is. But that's generally the math. So if you're out there just kind of wondering how to back of the envelope do the math, that's roughly what it comes out to. Expense ratio as a percentage of income, maybe 60%. So with that backdrop, what happens when you freeze rent for 2 years and your expenses grow 5%, which is, by the way, the RGB board's own conclusion. So Take $1 million gross income building, $600,000 for expenses. That's a 60% expense ratio. If the expenses grow at 5% for 2 years and rent's frozen, you lose basically about 16% of value, assuming the exact same 8% cap rate. So that's almost like a guarantee at this point. Short of them changing laws on vacant apartments, if the building sells for an 8 cap, your expenses grow 5%, you're going to lose 15 to 16% just on baseline NOI declination.
Over what period of time?
Over 2 years.
Over 2 years.
How do you think the condition is impacting valuations and kind of what you're saying about cap rate, location, average rent, and then condition? So a lot of the buildings and the assignments that we're seeing right now, the buildings in AEP, the violations keep going up. Nobody's at the wheel, right? Motivated to improve the property. So some buildings have been extremely well maintained and some buildings are falling into significant disrepair. How does that quality of the real estate impact what you're saying?
It matters tremendously. It changes the buyer pool. Just to give you a couple of stat points, we sold a beautiful 36 unit rent regulated property, Prospect Heights, beautiful. That traded for a low 6% cap rate. Buyers coming out of like Rodeo Drive pricing in Beverly Hills. I want to buy the best locations at the cheapest price I can in New York City. I might be wrong for a few years, but eventually I'll be right. I'm a young guy. We just put a 105 unit Crystal building, mint condition, no violations in Midwood under contract for 6 times rent roll. That was probably 7.25 cap. Also really quality building, low hundreds per unit. On the flip side, the problematic buildings, they're tougher to sell. We just sold, you and I both worked on this together, a 70 unit elevator building, Corona, right next to the casino. That sold for $4,750,000, but the cell site itself on the top of the building was worth 1.75. So effectively the 70 unit building sold for $3 million, which is $42,000 per unit, which is about the price of a really bad mobile home that you still have to actually pay lot rent. So we are now on the problematic buildings beneath what a trailer park mobile unit costs in Alabama for some rent regulated housing in New York City. So that buyer is just like, I'll figure it out 10 years from now.
Yeah, that buyer, basically the math for him was, if I could sell the antenna and sell the air rights, I own the building for free.
Correct.
That's basically what the math
So
was.
there is a floor in this building, 70 units, 28 vacant apartments. There was a pool in the basement that had, who knows how much, hazardous stuff in there. So there is a floor, but when you're trying to establish the floor, now you're playing with the gamblers. The people that are buying the quality buildings are looking for double-digit cash-on-cash returns. So really, if they can buy 8.5, and leverage with these guys at 6.25, and we'll get into that. Like on paper, assuming that the boiler doesn't break or the roof needs to be completely redone, you could, in theory, make a double-digit 10% plus cash-on-cash return. So if you combine an irresistibly cheap price per unit with a 10+% cash-on-cash return, you have a buyer pool still. Now, that might not be at the valuation you want, but this is the thesis behind the buy.
That's the thesis. All right, so Shaun teed this up nicely for you guys, Max and Jake. When we're selling the buildings and the buyers are, before they give us an LOI, they're shopping for debt, they call you guys and they say, Max, Jake, what can you get for me on financing these apartment buildings? And you call a lender and you say, hey, Mr. and Mrs. Lender, I've got a building I need you to finance in New York. What are some of the first kind of couple of questions that the lenders ask you?
Yeah, the first question is what percent of the building is rent regulated? So that's number one. Number two is if the units are in fact regulated, who is the sponsor and does the sponsor have experience managing these buildings? And so we've really seen a bifurcation in the market in terms of what it looks like to lend on market rate assets versus regulated assets. And it's been increasingly challenging over the last 24 to 36 months.
There's a bank or maybe 2 or 3 at the most that will really lend, I wouldn't call it aggressively, but lend on rent stabilized product and call it 60% plus of the units are rent stabilized. That's what we'll define it as. And then there's CMBS who will look at it as well. And we were actually speaking with the CMBS lender earlier. That's, I think, the biggest change in the lending market around these rent stabilized units is maybe from the last week, and the change is going to come from CMBS, because I think it's even more of a wake up call. Like the lender said to me, we'd consider it an 11 or 12 debt yield, but we're probably going to have amortization to start. If we're going to give any IO, maybe it's on the back end the last year or two, because they're looking at their exit in 5 or 10 years and seeing that the NOI is going to be less than what it is now. So they really have to amortize down the loan to be able to get out in a few years.
So if they're at an 11 debt yield today, what were they? Is that like, were they at a 10 or a 9 last week? Or is there any like?
Yeah, I think they're probably north of 11, closer to a 12 plus, and probably last week they were more in the 10 or 11 debt yield space.
Wow. Okay.
This is just
It's fresh. This
developing right now. Again, this on the CMBS side. The few banks that will consider rent stabilized are probably around that level, and then there's some other banks that have considered it for the right sponsor at even more low leverage, call it 50% of purchase price, and a sponsor that they've done business with.
Have you guys started getting phone calls from, I guess I'll call it opportunistic lenders? Shaun and I would get calls from opportunistic buyers as the market for debt has kind of thinned out a little bit. Are you seeing new groups? I've had some Bronx buyers say that they're getting loans from credit unions. What's kind of happening like on the ground?
So I would say there are some pockets of capital available for these rent stabilized properties. Like I said, I think credit unions are great. CMBS is another one. The agencies to an extent, and then there's one or two banks. As far as the debt funds and true opportunistic capital, I think maybe for the true bottom feeders where you could make a 12, 13% loan and be at such a low basis that there's some way you're going to get out. Maybe it's selling the cell tower or something like that. But I think for the most part, the debt funds want to stay away from rent stabilized right now as well. And that's also a function of, we were talking about this before we went on air, the question is like, how long does this environment last? And if you assume it's another 5 or 10 years, that doesn't play for a debt fund. A debt fund wants to be in and out of a deal in 2 to 3 years. What's their exit in 2 to 3 years if they're providing real leverage to a sponsor who's buying rent stable?
I have a question. If a lender is willing to lend at low leverage, let's say 50%, do they have a problem if the buyer gets secondary financing, like for instance from the seller? Because some of the we've done it on a couple deals where we bridge the gap between what seller wants and what buyers wants to pay by just like a hope note that's in second position at 1% interest rate, and it's like, hey, in 5 years I'm going to pay that extra $1 million that you want now, but I can't pay now. At a low, so is that a flag? I'm just wondering if that's a kosher way of doing things. Or?
I do think it is a kosher way, and I think a lot of lenders will consider that. I think a lot of it depends on who that seller or who that pref is from. Mm-hmm. If it's from an operator that they've done business with, that's all good. If it's from a seller that's owned these rent stabilized unit properties forever and knows how to manage them, that's also a good group to be behind a senior lender. From the senior lender's point of view, they want to know that if someone is behind them, whether it's the seller or a pref lender or an operator, that they're going to be able to deal with the issue if they do take it over. And listen, with these rent stabilized properties, there's not much more. It's not like you can start turning over units. There's tons of upside and make it better. So it's really, can they manage the property so that A, it doesn't go into default, and B, it doesn't go to absolute trash.
Yeah, the market for this product really already bottomed out, the last 2 to 3 years post signature. So we've seen some banks in particular tighten standards over the last 6 months, but as far as it relates to the 2-year rent freeze, it's too early to tell.
And let's take a typical example. I'm sure you get some of these calls every day. Loans coming due and already due, let's say. The loan amount is 5% less than the value. Are the lenders still extending that loan and just, hey, let's wait another year? Are you finding a lot of these lenders are just, again, if the property's not completely falling apart, saying we're not going to get refinanced out, but we're close enough, let's extend again? Is that still going on?
It's a really good question. It still feels like there's an element of extend and pretend. And I'm wondering when this will affect a bank's earnings, when they have to pay the piper on it. So I've seen a number of loans just float and get extended on a 6-month term or a new 5-year term because they're hoping for a better day at the end of the rainbow.
I have some borrowers who are just like, I'm just going to pay the old interest rate. I'm just not going to pay the new one.
I think making up payments.
I think it's a great question.
Like a tenant.
I think it's a great question for David and Spencer. But what I will say is, and maybe they'll jump on this, I think there's a big difference between whether it's, I don't know, right at value or the property's so impaired that it's 50% lower than the face value of the note. Mm-hmm. There's a different way of going about things for lenders in those two situations. I also think it really matters if the lender has recourse or not.
Right.
I agree with Jake. We've seen a lot of sort of pretend and extend. it often comes with the borrower giving in on some level, whether that's putting some cash in, paying it down, one and the same, or putting some money into the property to repair it and remove violations.
Or PG in the top part of the loan.
PGing some of it going forward, or paying fees to extend. The borrower is going to give something. But yeah, I don't think, and again, I think this is really more their admissions area as much as anyone. We haven't seen as much come to the market as I think maybe some of us realize could come in.
Yeah, Spencer, David, what's been initial reaction of the rent freeze from some of these lenders that you guys are representing? It was expected, right? To a certain extent. I don't think people expected necessarily
I bet against it on Kalshi, and
that was you.
That was me. I lost $100. I thought he would capitulate at the end of the day and throw his constituency a bone, but try and work pragmatically with lenders and landlords for two reasons. Number one, just to continue and maintain a lender relationship with the city with these buildings. And number two, show some favor or favorability to building new housing stock and having an outlook in the city that was reasonably pro-landlord and pro-developer, because the big schism right now, taking a step beyond rent stabilized, is just housing stock and housing formation and building new housing in the city. That's number one. So I lost $100. I went from.
I lost a lot more than that, David.
Right.
The lawsuit will be here, I'm sure, any day now. So the process will start and we'll bounce back up.
From a specific lender perspective, and speaking of what Shaun said before, Flagstar projected like a 7 to 8% decline in NOI across its book of business that was 50% or more rent stabilized over 1 year. So if you take that and you project it out over 2 years, it's exactly the figures he quoted. At 1.0 coverage over two reporting periods, i.e. 2 quarters, 1.0 coverage or less, that loan has to be reported as substandard by a bank. So there's lots of property in the debt service coverage space that is just keeping its head above water at 1.1, 1.2, 1.15. That year one is going to drop into a substandard category. And that requires that the bank take reserves against it. So it's going to create I don't want to say a landslide, but there's going to be a big step up in reserves that are taken by lenders. And we're talking about something like a $100 to $110 billion universe of rent stabilized loan exposure, the leader of which was originally Signature, and then number 2 was Flagstar, followed by a whole host of other lenders. Lenders have to take CECL reserves against expected losses over the lifetime of the loan. And so that's also a different calculation than just looking at debt service coverage year 1 and year 2 out. The CECL reserves, they have to be backstopped with real data and real assumptions. And if you have a 2-year rent freeze that's followed by another 2-year rent freeze, you could have a 7 times 4, 28% decline in NOI just on very basic inflation assumptions. And you really start to get into the problematic Bronx is burning sort of scenario of the late 70s, early 80s, when the city ended up owning hundreds and hundreds, if not thousands, of buildings and becoming a landlord. So there's the dystopian notion that comes about there, and then there's just sort of what are lenders doing today? And Spencer has a good handle on the least attractive assets that are in the alternative enforcement program and have high amounts of violations, and that's what I think scares lenders the most in the immediate term, is the stuff at the very bottom quartile of their rent stabilized exposure portfolio.
I think to address Max's point earlier and what David just touched on, for the assets that are 150, 200 LTV right now they're an AEP or they have several violations, that's where
per unit.
Per unit, that's where we're starting to see lenders market those as one-offs or in small portfolios. But going back to something that David said before, yes, lenders are increasing reserves, but it's on a quarterly or a semi-annual basis where they say, okay, I'm going to sell X amount now, but I'm not going to take my entire distressed, rent stabilized, rent control book and sell it all at one time because they can't take that level of a hit right now. For assets that are paying even at the existing rate without the default rate, where it's more like 95, 100 LTV, we are seeing lenders extend and doing everything that they can to work it out with the borrower. And I think a function of that is even if the loan's at maturity or it's about to be at maturity, the pricing level that buyers are going to pay for that asset is still at a significant discount to par, because you can, if you assume, yes, I can work something out with the borrower and the borrower is going to keep paying, that's one thing. But if you're an investor, put yourself in their shoes. Worst case scenario is this borrower stops paying and now I have to foreclose. Okay, now you're entering into a 1, 2, 3 year foreclosure process, and your cost in doing that and time value of money is going to completely destroy the loan value. So that's what lenders I think are wrestling with, which is why we're seeing some of the bigger names right now in the space, guys that are lending with Jake and Max, start to show off one-off rent stabilized real issue deals that they're selling that are $2 million, $5 million, $10 million in balance, and slowly starting to offload those assets.
Do you think that's a better strategy to do it one-off, or would they get more attention from your note buyer pool if it was 15 or 20 billions at a time? Forget about their loss reserves.
So because of the buyer base right now for these assets, the smaller portfolio or one-off trades are very effective because a lot of these buyers are your private individuals.
Yeah, it's too much diligence to handle at once.
And they only have a certain amount of capital, right? There aren't that many behemoth private equity distressed debt investors who are looking to gobble up a massive amount of issued, troubled, rent stabilized deal. On the performing side, that's a different story, because we could talk about some trades that are occurring now on the performing side where there's actually a securitization exit for these performing loans. So because of that takeout, people can really extend on pricing. But someone looking at the notion of gobbling up 20, 30, 40 rent stabilized NPLs where they're going to have to put a ton of asset management into those, there's few and far between investors.
How does a buyer evaluate one of these buildings in AEP? Are they buying it if the regular bank lends on a regular deal at 11 debt yield? Are they like a 25 debt yield, assuming that they even collect the rent? Or are they just banking on the borrower being able to refinance them out once there's a new sheriff sending them letters? Walk us through the thesis of that type of buyer, because you are finding stuff that I'm like, I don't think you can sell that for anything. And you come to my office and say it's done.
Yeah.
That calculation is taking your math before on a per unit expense basis and a fully loaded real estate tax basis with pulling out any sort of remnant J51 tail and then looking at the actual rent roll. And then I think building in any sort of treble damages calculation on a conservative basis to protect them, and just looking at sort of total debt per unit by borough and where they absolutely either can't lose money or they're just going to collect rent for 2 or 3 years, not pay anybody, and then walk away. So there's a couple of different sort of very bottom end calculations that go into that, not the least of which is what is the dollars per unit that the lender lent to begin with. So there's also a dichotomy in the space where Signature just went bananas from 2020 to 2023, and they have almost double the leverage on a per unit basis of Flagstar. And then Flagstar was at the upper end of leverage per unit, but still reasonable. And then there's a whole cohort of other lenders that have less leverage per unit. But Signature just went sort of off the reservation. So the starting point, if you just sort of baselined everybody and said, I'm not going to pay, I would never pay on a loan more than $110,000 or $120,000 per unit in the Bronx. And then you're working down from that. If you have a loan that's got $200,000 per unit or $175,000 per unit, that first haircut just takes you down to the borough average. And then the calculation begins of what am I going to discount off of that, because I'm never going to get back to more than 120,000 a unit in value on this distressed building. And you also have to consider that the city is focused on the AEP assets, so the lender doesn't want to own it. They don't want to foreclose. They're almost like environmentally tainted property where you would not foreclose on a brownfield or something that had oil contamination.
You don't want title.
You don't
want
want
to own it.
You never want to be in the chain of title.
Who wants to own those?
That's the problem.
It's these private individuals and these small funds who are looking at it from a collection basis, and it's a sort of, I can't lose money at this type of this
Chasing outsized returns.
Yeah. I mean, we're talking high teen, low 20 IRRs on a small deal.
How does that compare to other product types or locations that you guys are selling across the country? Is this like super?
Yeah, take for instance all the Sand State B and C and workforce housing foreclosures in the multifamily space that have gone on for the last couple of years, and all the non-bank lenders who have sort of blown up lending into that space. Those portfolios in Texas and the Southeast and Phoenix are trading at 70 cents on the dollar, 75 cents on the dollar. So this is not just specific to New York. Lending got out of hand across multifamily all around the country, and there's more institutional money available in those MSAs because you don't have rent stabilization and you don't have this onerous government oversight. Rent stabilized property here or rent control in California or other cities where they put rent restrictions in place, there's always a negative effect. It contracts housing supply. It actually contributes to rent inflation. There's all sorts of textbook examples showing why that doesn't work, and that drives institutional capital away from those areas. So that also contributes to the cost of capital that Spencer's talking about, where the replacement for that institutional and cheaper capital, which actually benefits tenants and benefits housing supply, is just more expensive private hard money type lenders. So it's sort of a self-inflicted wound to not at least strike a balance between the needs of tenants and the needs of landlords and lenders. So
Are these note buyers, are they financing these note acquisitions? Are they paying cash?
It's mainly cash buyers, but going back to what Jake and Max said before, there is a cohort of more opportunistic lenders, mostly private capital out there from what we're seeing, who are lending at 10 to 13% 2-year money, where they lend to the note buyer. The note buyer takes X amount of time to foreclose, and then the lender who lent the note on note was looking for the note buyer to enact a foreclosure, own the property, and then at that point, their borrower who owns the property is a much better quality borrower than the borrowers who are defaulting on these assets with the bank.
And their look-through basis is 75 or 80% of the note purchase price, which compares to
20 cents on the dollar. Yeah, on the initial loan.
Yeah.
The note on note or lender finance business generally has a 60 to 75% advance rate on note purchases, but those are typically at a higher percent of unpaid principal balance on the original purchase. The note on note lender or the hard money lender that's advancing to somebody buying a very distressed rent stabilized note may be in at 20, 25, 30 cents on the original unpaid principal balance dollar. And even there, they're concerned it's a thinner market. So a very large portfolio of distressed assets is going to have challenges getting financing. And a good example of that is this Wiener portfolio that traded in Brooklyn about 6 months ago. And right at the point of trade, when Flagstar was selling the loan in a bankruptcy 363 type sale, the mayor stepped in and tried to pause that transaction. It was actually allowed to go forward by the court system. And the recovery was 80 cents on the dollar on a lender finance basis or 75 cents on the dollar on a cash basis. I even question the validity of the cash bid. I think that trade really only occurred because Flagstar was willing to provide lender finance.
And why don't more banks do that? That's an open question maybe for you guys. If you go to Seth and Shaun with a building to sell, the lender's involved. If the existing lender will just stay in the deal, get right-sized down a little bit, get paid down 10% of the loan amount, but finance for the next borrower at a better balance sheet, it does increase the probability of outcomes quite a bit. It seems like they just want to get out of the space, but if you don't want to sell the loan for 50 or 60 cents and this is the only option is to get paid down, to me, it's a good option.
You need true sale treatment as a lender to recycle that loan out of being substandard or special mention or regulator focus. And true sale typically means you need at least 25% cash in. So even if you were to provide 75% leverage on a transaction like that, it's still hugely beneficial because
I would say we've seen it a good amount. Like I do think most of these lenders, or a good amount of them, have stayed in and sort of recapped their loan.
a non-bank lender is definitely far more likely to stay in. You know, you look at a Benefit Street, for instance, they're willing to finance, or Ladder, both very willing to finance things and take more real estate risk.
This is a regulatory issue. Is the FDIC or comparable
FDIC,
group
OCC.
is saying, hey, bank, you got to conform with these rules, and therefore you can't really do it?
Yeah, think of if you weren't regulating that business, then banks might finance 99% of a purchase price to have an inflated purchase price, and the bank quality would continue to deteriorate. You could just recycle all of your bad loans into new loans, and that's how a lot of non-bank financial outfits get into trouble when they take back a property or they're in foreclosure and they just roll it into a new buyer at the same basis. And
the wheel deal are like borrowers that we deal with. This is like probably one of the biggest misconceptions or lack of understanding that they have, where they'll say to us, I made my lender this great offer. I don't know why they didn't take it. And then maybe 6 months go by and then the lender comes back and says, hey, we'll do the deal. And the borrower's like, well, the environment has changed significantly. Yeah. My offer's off the table. I can't do it. Let's reassess. So yeah, that's interesting.
That ship has sailed.
How do you think, and you guys kind of touched on this a little bit, what factors are these lenders, when they're sitting around their boardroom or whatnot, are they typically weighing when considering the options between A, selling the note, B, starting a foreclosure, or C, giving the borrower a discounted payoff to stay in the deal?
Yeah, I think the biggest thing is sort of how the correspond.
Exactly. Like the relationship with you and the borrower. If you're a dick, they're going to treat you like a dick.
That's right. The correspondence with the borrower. If the borrower is actively attempting to right-size the asset, is on top of their tenants, is putting in CapEx, is clearly making an effort to improve the status of the property and work with the lender, then there's more rope. Additionally, the other thing that they're considering is how many of these do I have, right? Because if there's a massive portfolio, then versus a couple here and there, they don't mind holding those smaller assets and sort of kicking the can. That's why these much bigger lenders who have a much larger portfolio are starting to offload loans now, because they have too many to handle, right? So there's that. And I also think it's also around the foreclosure, right? If a lender feels like there's a deed in lieu situation versus someone who's going to be competitive during a foreclosure, the lender is going to probably try to exercise that deed in lieu option versus knowing that they have to enter into a 12, 24, 36-month foreclosure. And once they start getting into that process where they default the borrower and that foreclosure kicks off and they're 3, 6, 12 months down the line, and there's no communication or the borrower is being litigious, at that point is often when we see them come to us and say, hey, we got to sell this note because otherwise we're going to be stuck in this thing for another 2.5 years. And we can't do that for multiple reasons.
Interesting. Let's talk maybe for a second about the differences in due diligence between these two transactions. So Jake and Max, when you're sizing up a deal to finance or refinance, what are the lenders asking of you? And then similarly to David and Spencer, when a borrower is looking to buy a note, what are some of the diligence requests that they ask for? And and you're able to provide versus, hey, I don't have that or I can't give that to you. So why don't you guys start? What does a typical bank diligence look like to finance something right now?
It's obviously starts with the T12 and what do the numbers look like from that perspective. And then it's backing up the actual expenses. And obviously the key component, I'm sure they see this too, is backing up the paperwork.
You're talking about IAI,
Yeah.
like deregulation paperwork.
Yeah. That's obviously crucial. I mean, listen, it plays a little bit more into properties that are deregularized.
Of course.
But yeah, I mean, it's really not that different than it always was. It's just nailing down the actual T12 and the collections and those numbers is a little more scrutinized than it used to be.
Yeah, I would add today more important than ever with respect to the subset of properties we've been discussing. The sponsor bio is crucial, right? Do they have experience? Is this their first buy? How many of these have they bought? What do the violations look like across the portfolio? Oftentimes, if we're financing a stabilized asset with a lot of violations, a bank will come back and say, I need to look at the buyer's portfolio just to get a feel for how they do things if they're going to overlook the seller's violation. So I think that's really the critical piece.
I think that's a great point. On the refi, if you're walking in there with a whole bunch of violations, you're kind of dead in the water because what has the borrower been doing?
There's no incentive, right, for the bank to lend you the money.
And this is an interesting point too, is I imagine one of the other questions the bank asks or they do a search on is, or it's like that little form you say, have you ever had a foreclosure? And to your point, what leverage does the bank have even on non-recourse debt? To some extent, we've forced borrowers or got them to agree to do a deed in lieu, hey, friendly foreclosure, because they didn't want the foreclosure on their record for when the next cycle happens. And that was literally the only leverage we had.
Yeah.
It worked because I was like, yo, you're not going to get a loan the next time. You want to stay in good graces so you don't have to say I've been to prison or whatever.
What's interesting is though you said the bank doesn't want to refinance with the existing borrower if the violations are getting out of control, but then that kind of 2 steps down the road, it's well nobody else does either. So now you're in the bed with the borrower.
It's a game of chicken.
Interesting problem. Is it chicken and the egg?
Yeah.
Those are the types of loans that the banks are selling, right? Massive violations where the borrower can't refi out. And touching back on the DHCRs, because we talk about this all the time, Shaun and I, we never get those. We just don't get them. These banks from these 2021, 2022, 2023 originations, it's now 2026. Do you have the original DHCRs? Do you have any of the updated DHCRs? The answer is 95 to 99% of the time, no. Mm-hmm.
In the rare instances we get them are instances where we're working with a broker at Marcus Millichap, and the original lender signatory on a recorded document can sign a request to DHCR to provide those. And these guys go down and can actually get them. Mm-hmm. And that's the first step in us trying to create a diligence package that was accretive to the property price or the loan price. The second step, and this is where you really have to introduce a collaborative process between a broker, either note sale or investment sale, a financing agent, and the lender and the borrower. So this bridge the gap process that we did a year ago that worked in a few instances was like a tri-party listing agreement where the landlord was willing to share all of their paper, IAIs, leases, and DHCRs. The lender was willing to list the property and the note simultaneously, and the broker had access to show the property, and it was an open book for all parties. The lender was comfortable that they were going to have transparency in the offers coming through. And to the landlord who wants a DPO and is willing to offer a reasonable number, and to the brokers that run that process, that's the only way to really get to a transparent price that could either be you sell the property to a third party because the landlord just wants out, or the landlord wants to stay in the deal and the bank needs transparency into the marketplace that they've been offered, that the property was fully marketed, all the information available was made available to buyers, property tours occurred, and that gets the best resolution today. And you bring in financing, and so the new lenders are comfortable that it's a real transaction. It's not a cash in or cash out refinance. It's not an artificially arrived at transaction price. So that kind of very intensive process where everybody's collaborating and the landlord has to be collaborating.
Yeah.
And
So like on a bumper sticker, you're basically saying, I'm the bank, this is the borrower. In order for me to ever consider a DPO in the future, I reserve my right not to, but in order for me to consider that, you need to prepare all the due diligence items, the IIs. We need to put it into a Dropbox, and we need to go about this from a transparent way. That's essentially what
And I think it goes one further. And you got to go run the process and see what the financing market will give you and see what the buyer market will give you so that we can see that, all right, it's not worth anything more than 80 cents on the dollar, and that's where we'll trade it for you. I think you have to go through that whole process, like David was saying, with the different parties involved and that full transparency. We've seen it a good amount on the office side, actually, where office properties are 30% of what they were in value, and you have the lender. It's been Signature at times, by the way, Rialto now. You've seen the lender and the buyer or the existing borrower and the brokers all work together to really establish. What you're really doing is establishing the real value.
Right.
Rather than do the negotiations behind closed doors between borrower and lender, and it's like, psst, what did they say? Psst, what did they say? So no, let's just put sunlight on everything. We're all in one big publicly traded company. We're all in the same office, and we did this recently a couple weeks back for a large owner with a fully stabilized portfolio and with multiple different lenders. We BOV'd the entire portfolio. These guys, Jake and Max, gave them loan quotes on what their NOIs would support today, subject to appraisals, and they can take that back to their lenders if they want to and share it with them. And simultaneously, the borrower invited each of their respective lenders to talk to the guys, David and Spencer at Mission Capital, to be like, look, we're getting BOVs on the real estate from Seth and Shaun and debt quotes from Jake and Max. Why don't you guys go get note valuations on these notes, and then we can just kind of talk and figure something out.
Right.
And that's basically the idea.
That process makes the note valuation almost equivalent to the real estate valuation when it's just an open book. Maybe you have a deed in lieu in a box. The borrower wants out. There has to be a collaborative process.
Yeah.
And our diligence package becomes Jake and Max's diligence package and your diligence package. I mean, the more information that's in that Dropbox, the better.
Yeah, the better. We're three legs to the stool, basically, trying to work collaboratively together.
Three amigos.
There's one other point that's off topic that I wanted to mention. David hit on it a little bit, but one of the things that June 19 laws and everything that's happened since then is created is it's made, and this happened really a few years after COVID too, but it's made free market New York City multifamily properties gold. Gold to buyers, gold to lenders, equity groups. I think for a while people left New York and there was this feeling that it was like, oh, let's go down to the South, Midwest. There's so much rent growth there. And what I think those people are now learning is there's also no barrier to entry there.
Right.
What the politics have created here is an unbelievable barrier to entry where because of the 485X is a pimple and you can really just build 99 or maybe 149 units. You can't really build ground up here. You can't convert rent stabilized to free market. Other than the conversion space, there's really no way to create new free market units here. And there's still this incredible demand. And now we see equity groups, we see lenders, and obviously developers and owners coming back here and seeing that. And in that respect, New York is always what it's been. It's one of the best places to invest in.
Yeah,
you're going to have
You have
quickest risk.
You have this bifurcation and like
it's a
crazy
wild bifurcation. It couldn't be any bigger right now.
It's crazy. We have this building in Harlem. I can't give it away for $50K a door. And then literally yesterday, the day before in the Bronx, we signed a contract at $100 a door.
Yeah.
In the Bronx, $100 a door.
We're doing construction loans on office to resi conversions at $600,000 a unit.
So there's equity out there. There's debt and equity for the right opportunities.
Yes.
Yeah, multifamily in New York City is still gold.
Gold.
Free market.
And
more than ever before. And the rents are higher than they've ever been and the vacancies as low as.
But that tells you that the construction costs still work. And those construction costs would work for affordable housing if there was a coming together of assumptions and expectations and and not shooting yourself in the foot by not at least keeping pace with inflation. So there's a willingness to build in the city, and there's an ability to build. I mean, people think New York is impossible from a permitting and a architectural perspective, and that's not really true. California may be, but New York, you can build, and there's construction all over the city. I mean, the city is on fire right now.
All I do is walk under scaffolding. I haven't seen sunlight here in a long
Listen,
time.
the 485X, the 467M, which is the conversion affordable tax abatement program they rolled out, is actually really creative. And and you're seeing, there's other factors. Obviously, the office market going down in value, and like we've said, the free market rents just going out of control factor into it. But that abatement has made conversions, even buildings that were bought 2 years ago to keep office, that are now being converted to multi, they've made those feasible at higher bases. So I agree with you, David. There is a willingness here, and there is an incredible need for housing, particularly for that 20 to 40-year-old generation, that people are still coming here. People still want to be here.
The Spencers.
More than ever before. Yeah, exactly. But it's really challenging to ground up, and it's really challenging when you have a whole set of apartment buildings that you can't do anything with.
The hybrids are a very interesting place, right? The 50-50 free market rent stabilized. Yep. Maybe you can pick them up at a higher cap rate going in than you otherwise would. You can at least stay afloat, right? If you do the same calculation we started with, but you're taking 5% rent growth on the free market portion and 0% the rent stabilized and expenses go up 5%, it probably is a break even. But those cap rates are elevated right now, and then you're still got a little bit of a hedge.
It depends on what you can do with those free markets. We're working on one in Brooklyn. That's another deal that one of our guys are selling. And listen, that deal has gotten a lot of love from the buyer community, and lenders, value add bridge lenders love that deal because you can add value on the free market units, even if it's only half of them in the building. That's a deal that has a good amount of rent stabilized, but has really been looked at favorably by not only the buyer community, but also the lenders.
Yeah, interesting.
Spencer, what were you going to say?
We sold an 8-unit deal free market in Yonkers probably about 3 months ago now. Sold for 97 cents on the dollar. You won't see that type of pricing for rent stabilized. It's 70s vintage building, 75% occupied, nothing special, but we sold it for almost par and true NPL, borrower not corresponding with the lender. But yeah, that high 90s pricing, you're just not going to see that today for 99% of the rent stabilized product that's in the market.
Yeah. Well said. All right, guys, we're coming up on the hour here, so I think it's time for us to go back to. If anyone wants to reach out or talk about anything, feel free to reach out to any one of the team members here, and we're happy to help in any way that we can. Set up group calls between borrowers, lenders, whatever anyone needs. We're here to help.
We'll find our way through the darkness.
That's right, exactly. Thank you, everyone.
Thanks, guys.
Thank you.
Thank you.
Guys.